All right, on the radar today, REITs. What else could it be when you've got Dennis Mitchell on the desk, the CEO and CIO of Starlight Capital? And I guess it was kind of a long winter for REITs as we were in this elevated rate environment. Now we're in the easing cycle. Can we just take stock of maybe what's happened over the last year and what's happened over the last 3 months?
Sure. So at the start of the year, ironically, we wrote a piece about reinvestment risk, and we said, listen, if you're locking away for 2 years at 5%, you're probably going to be very disappointed 2 years from now when you mature into an environment of lower rates, higher multiples, and lower total returns. And collectively, advisors kind of looked at us and said, talk to us at the end of the year. Well, here we are closer to the end of the year, and that message is resonating because, of course, central banks are cutting rates and REITs have rallied. So I think there are a couple of charts that I had sent over, a couple of pair trades to show you exactly what's happened. Technology versus real estate, energy versus utilities. And what we've seen is if you go back to the end of 2019 and you look at technology versus real estate in the States, the S&P 500, technology stocks were up 157% versus real estate up 13.5%. Dramatic outperformance. In the case of energy versus utilities, it's 88% versus 29%. So that was while interest rates were going up significantly, inflation was elevated, and growth, of course, was stronger than we're seeing right now.
And then you'd have to be so bold to look at that chart and say, you know what? If you're talking pair trades, now I'm gonna go into real estate at the expense of tech.
Well, yeah, but here's an interesting anecdote. A friend of mine had their advisor reformulate their portfolio, and they recommended 4 new mutual funds: a tech fund, an innovation fund, a large cap fund, and a dividend fund. And when I looked at the 4 funds,
they're the same.
The top 10 was all the Mag 7, right? So there's no marginal buyer on the sideline saying, I'm waiting for NVIDIA to pull back so that I can invest. It is an extremely crowded trade, and you can see that in the stock chart. But what's interesting is what's happened since June 1st or May 31st, when the Bank of Canada commenced cutting rates and the Fed followed in September. What you've seen since then is technology is up 10%, that's fine. Real estate's up 18.5%. Energy's down 4.5%, you just talked about that in the last block, and utilities are up over 12%. So you've seen leadership rotate into the defensive, higher yield sectors. That's going to continue. And your catalyst, there's 2 catalysts. Well, sorry. You're in a situation where utilities and real estate were undersold, they were cheap, but that's not a catalyst in itself. Your catalyst going forward are every single rate cut, right? That creates an even more favorable environment for these 2 sectors.
So the question becomes, can this continue? Is this just kind of a flash in the pan, a little bit of mean reversion? How do you think about whether these sectors like REITs, like utilities, have moved too far too fast?
Right, so we never comment on too far too fast. Things don't go straight up or straight down. What's more interesting to us is, if you looked at the start of the year, Canadian REITs were trading at a 33% discount to NAV. They're now trading at an 18% discount to NAV, and historically they've traded anywhere from 0 to 10% premium to NAV. So you're still talking about north of 20% total return in Canadian REITs just from multiple expansion. Add in a 4 to 5% tax-efficient yield and about 3 to 5% internal growth, and you're looking at north of 30% total returns from this point going forward, catalyzed by rates continuing to come down.
Now that's across sectors. I think this is a sector you have to be really nimble. Maybe given the uncertainty around office, this new discount is appropriate. Would you agree with that, or are you getting bullish on office too?
I would agree with your initial premise that you have to be nimble and you have to kind of look at each individual name and sector. What I would say is that CBRE reported that office vacancy nationally is still around 19.3%, and it's still going in the wrong direction. So I think there's plenty of time to kind of take your, ease into office when we start seeing some troughing activity. On the other end of the spectrum, seniors housing is a sector where they were hit disproportionately by the pandemic. You had, unfortunately, a number of outbreaks in seniors facilities, and that drove occupancy down from sort of mid-90s to low 80s. And so what we've seen since then is you've got sort of a number of drivers. One is more people are now moving into these facilities and driving occupancy up. The increased occupancies are putting upward pressure on rents, and we're not seeing a dramatic supply response. A couple weeks ago, I was in the Montreal market actually touring seniors facility assets, because the Quebec market historically has been a market that has seen a lot of supply pick up in a short period of time, and that's undermined occupancy. We're not seeing that this time around. So One of the names I had for you is Chartwell Seniors Housing REIT. And the reason we like it is there are three sources of return from any equity. The yield that it pays, and in the case of Chartwell, it's about 4%, but it's very tax efficient. The multiple it trades at, and Chartwell has had a fantastic run year to date, and the 1 year number you can see for yourself, over 50%. But again, what is going to drive that higher is the fact that their occupancy is only at 89%, and they have guided towards 95% by the end of next year. So there's significant room for cash flows to grow, and even if you keep multiples constant, that should continue to push the stock further.
So it actually has reclaimed all of the losses since the pandemic back to where it was before. Do you prefer Chartwell over Sienna Senior Living?
Yeah, without going into too much detail, Chartwell is 100% seniors housing, whereas Sienna's got a big chunk of long-term care. So our preference is for seniors housing, where it's not as heavily regulated. There's the ability to grow cash flows and rents because it's private pay, right? If you're moving into a Chartwell asset, you're paying your own way. Whereas if you're moving into long-term care, the government pays for food and care and activities and such.
You've also got a U.S. pick for us, Starlight Capital.
Yeah, so straight up interest rate play. Mortgage REITs are a spread game. I can invest at 4%, my cost is 2%, I earn a spread of 2%, I lever that 5 times, 10% yield, right? So as interest rates come down, magic happens. The book value of the assets goes up as interest rates come down, and at the same time, their cost of capital comes down, increasing their spread.
13% dividend yield, sustainable?
Yeah, the payout ratio is just under 100%, but will continue to come down as rates come down.
Okay.